The program introduces enterprise risk management, ERM, as an integrated framework for identifying, assessing, monitoring, and managing risks across an entire organization. Unlike traditional approaches that treat risks separately within business units, ERM evaluates all major exposures collectively to provide a comprehensive view of enterprise-wide risk. The program explains that organizations face numerous interconnected risks, including market risk, credit risk, liquidity risk, operational risk, legal risk, strategic risk, and reputational risk. ERM enables management to understand how these exposures interact and potentially offset or reinforce one another. This integrated perspective improves strategic decision-making, strengthens financial stability, and aligns risk-taking activities with long-term organizational objectives and stakeholder expectations. A major advantage of ERM is its ability to improve efficiency and reduce unnecessary risk management costs. The program emphasizes that firms using integrated frameworks can identify situations where certain risks naturally hedge each other, eliminating the need for separate mitigation strategies. ERM also supports better capital allocation by directing resources toward the most significant threats facing the organization. Senior management and boards of directors play critical roles in defining risk appetite, establishing governance structures, and ensuring that enterprise-wide policies remain aligned with strategic goals. Many firms appoint a chief risk officer to oversee ERM implementation and coordinate communication among departments, regulators, and executive leadership. Effective ERM therefore combines governance, analytics, and organizational coordination. The program further explains that ERM frameworks rely heavily on quantitative and qualitative tools to measure and monitor risks. Institutions commonly use value-at-risk, stress testing, scenario analysis, sensitivity analysis, and key risk indicators to evaluate potential exposures. Stress testing examines how portfolios or operations may perform under severe but plausible economic conditions, while scenario analysis explores the effects of hypothetical future events. These techniques help firms understand vulnerabilities that may not appear under normal market conditions. The program emphasizes that effective ERM requires continuous monitoring because risks evolve over time due to changing market environments, technological innovation, regulatory developments, and geopolitical uncertainty. Dynamic assessment therefore supports proactive risk management and organizational resilience. Topic focuses on risk culture and its importance in supporting effective enterprise risk management. Risk culture refers to the shared values, attitudes, behaviors, and practices that influence how employees identify, communicate, and manage risks throughout the organization. A strong risk culture ensures that employees understand the institution's risk appetite and act consistently with governance expectations. Senior leadership must promote accountability, transparency, and ethical conduct through clear communication and appropriate incentive structures. The program stresses that risk culture cannot be improved simply by appointing a chief risk officer or introducing new policies. Instead, cultural change requires organization-wide commitment, ongoing education, and reinforcement through leadership actions and operational practices. Scenario analysis is another major topic covered in topic. Scenario analysis involves evaluating the potential effects of hypothetical events or adverse economic conditions on organizational performance. Unlike traditional statistical models that rely heavily on historical data, scenario analysis considers forward-looking situations that may not have occurred previously. Regulators such as the Federal Reserve require banks to assess baseline, adverse, and severely adverse economic scenarios as part of stress testing programs. The program explains that scenario analysis helps firms identify hidden vulnerabilities, evaluate capital adequacy, and prepare contingency plans for extreme events. By considering multiple possible outcomes, organizations improve strategic flexibility and strengthen their ability to respond effectively during periods of financial stress or operational disruption. The topics conclude by emphasizing that successful ERM depends on the integration of governance, culture, analytics, and communication across the organization. Institutions with weak risk cultures or fragmented oversight structures often fail to identify emerging threats until losses become severe. Historical financial crises demonstrate that excessive risk-taking, inadequate transparency, and poor governance can undermine even large and sophisticated institutions. Effective ERM frameworks therefore require active participation from boards, senior management, operational teams, and regulators. The program teaches that enterprise risk management is not merely a compliance exercise but a strategic discipline that supports long-term sustainability, financial resilience, stakeholder confidence, and informed decision-making within increasingly complex global financial markets.